All right, so our speaker today, Ed Morrow, is a familiar face. Ed is currently the Regional Wealth Strategist for the Eastern United States for U.S. Bank's Private Wealth Management Group, where Ed concentrates on thought leadership and planning ideas for high net worth clients in the areas of tax, asset protection, and estate planning. Ed received his JD from Lewis and Clark Law School, an MBA from the Williams College of Business at Xavier University, and an LL.M. in tax from Capital University Law School. I say the following with permission. Ed is a self-professed tax nerd and is a frequent speaker at CLE programs and CPE programs. Ed has been here for our annual conference with the tax section in September, a couple times I believe, and then spoke at an estate planning council meeting a few years ago, one we had up at Crane Creek. Ed has also recently co-authored the 18th edition of the Tools and Techniques of Estate Planning, which is a very extensive practice-based resource, and informed me earlier this morning that there's a 19th edition that's coming out soon, so you want to look for that. I wanted to mention that Ed is visiting us on his own time. He took a week off. I think you have some family in the area, and apparently has enjoyed his time out here in Idaho speaking. So we really appreciate you coming out, Ed. The title of the presentation is Internal Revenue Code 678 and the Beneficiary Deemed Owner Trust. Let's please welcome Ed Morrow.
Thanks, Dave. Okay. Everybody in the back hear me okay? I think we got this working. So yeah, it sounds like a mouthful. We've got another acronym to learn, BDOT. You know, as attorneys, we'd love to create these Q-tip, BDOT, all these kind of different acronyms. But at a nutshell, you see from the title, we're talking about making trusts simpler and more income tax efficient. Now, we'll have a few kind of ideas surrounding this that apply to the super high net worth and taxable estates, and maybe doing some planning that might improve the estate tax situation. But I know, but at its core, the bread and butter of this idea is really for the middle class. It's for people that are using trusts and they want to avoid the non-grantor trust tax system that can be disadvantageous to our clients in many respects. So with that, let's go into a little bit about the, I'm going to turn this gizmo on here, and then go in, there's a little bit my contact information if anybody wants to email me with further information. Here's our course theme. Kind of start with a little bit of an inspirational wisdom to get us going here. I kind of cribbed this, as you can notice, from my friend TJ. You know, we hold these truths to be self-evident, that all trusts are not created equal, that they're endowed by their creator with alienable rights. Among these are the power to defer, avoid, and shift taxation and shelter assets from creditors. And that attorneys are endowed with certain powers to arrange such trusts as necessary for the public good. Public good meaning for your pocketbook and your clients, right? Okay? We have a lot of power to manipulate trust and change trust and manipulate income around to basically get a better deal for our clients is what I'm saying here. Maybe it's not quite as important as, you know, the Declaration of Independence or anything like that, but, you know, it's still inspirational to me that we can do some good for our clients with these kind of ideas. So I'm going to cover an article that was, anybody here get the Lineberg Information Services newsletters? Anybody subscribe to that? Not as many people. It's a great newsletter service with a lot of on retirement planning, income tax planning, estate planning. I write for them. It's a little bit like trust and estates and things like that. But this is basically going to cover that article that was published in September, and I've updated it. I think Tom sent out the link to the longer white paper. So everything that I'm talking about here has more details with lots of footnotes in that article if you're kind of curious and you want to call BS and say, what was that talking about there? I'm not sure I believe him. You can go to the white paper and get a little bit more information about that. But you don't need that for today. But just in case, and if you want to go back to this maybe a year later or 6 months later, if you go to that website, I generally put any updates on that SSRN website too. So here's kind of the agenda. It's kind of chock full of a lot of, you know, heavy-looking stuff, right? We're only talking about one code section for the most part during this presentation, and it's actually only, you know, a couple of dozen words. So it's not as complicated quite as much as it looks here. So we're going to talk about some basics of fiduciary income tax system and how trusts are taxed, some of you prepare 1041s and you know it really well, but we're going to get up to speed for everybody to understand it pretty well at a basic level. And then we're going to talk about, IRC 678. That's the main code section we're going to be talking about today, and how we can exploit that particular code section in different ways that people aren't necessarily thinking about. So we'll talk about those and, the definitions of income. And we'll talk about how lapsed powers and powers of withdrawal are treated for estate tax purposes, for asset protection purposes, for state law purposes. And there's a 50-state chart that's included in the white paper material that has the law in every single state and jurisdiction, including DC. What is the asset protection effect of powers of withdrawal and lapses of powers of withdrawal for you to consult, including Idaho, the rules for that. So we'll talk about those, and we'll contrast with BDOTs and things like that, and we'll contrast with crummy powers. And even if we have time at the end, go into some instances where maybe we could take existing irrevocable trusts and turn them into a BDOT. BDOT is Beneficiary Deemed Owner Trust for that's triggering Section 678 of the code. So income tax planning, no surprise to you guys. It's much more part of estate planning than it's ever been, because the estate tax exemption has gone up so high. It's going to be $11.4 million next year with the new inflation adjustments. If you got a married couple, you take that times 2, 22.8. Now we know there's that fiscal cliff in 2026, et cetera, et cetera. But for now, this is affecting very, very few, very little of the population. According to Trump's advisor, those people are morons, the people that actually pay estate tax, if you remember that quote. But the estimate is 1,700 people will actually file returns in 2018 on 706 tax returns that actually owe any kind of tax. So it's a pretty slim part of the population. So we've become, if you're in the estate planning world, and we've kind of become income tax advisors indirectly, because the income tax has become more important than the estate tax for most of the people that we're working with. So there's 3 problems to address for the middle class, and by middle class, I'm making that a very broad statement. I mean, people that aren't worried about estate tax as much, that could be people with $20 million, right? So if you count that as middle class, maybe you do or maybe you don't, but I'm using that term really broadly here. There's 3 problems from an income tax perspective with using trusts, right? One is if I have in your basic AB marital trust planning, if I've got a bypass trust, I'm not getting a step up in basis at the surviving spouse's death. And there's ways to, I think that was a topic 2 years ago when I was here. We talked about formula powers of appointment and how to exploit those to get a step up in basis and avoid a step down in basis. The other 2 issues, that's going to be the topic for today, is the higher compressed tax rates applicable to trust, and the fact that certain assets and certain categories of income and deductions do not get the same treatment for non-grantor trust as they would for an individual. And we'll even go into the new 199A deductions, since that's been in the news a lot, with the new tax reform and the proposed regulations that came out in August. We'll talk about those. So the point of this is really to turn these negatives into positives, so that we can safely say to the clients that, you're not going to get worse tax treatment using a trust. You can get all the asset protection, the bloodline protection, the protection for your kid's divorce, all these protections that we use, advantages that we use for trust for. You can get all these without having an income tax negative. That's the point of this talk and paper. So we're going to be talking about the grantor trust rules, which I just kind of put these up here just to kind of tell you what code sections are what for the tax nerds that want to know what we're talking about. We're going to be talking about 671 to 679 are the grantor trust rules. When is the trust not deemed to be a separate taxpayer? When is it deemed to be taxed to either the settlor, the grantor of the trust, or a beneficiary of the trust under 678? So just some fundamental concepts that we want to get across here first as a starting point. Trusts and estates are generally separate taxable entities unless you come under those grantor trust code sections. And the income is divided between the trust and estates and as a separate taxpayer and the beneficiary. It's not like a flow-through S-corp or LLC taxed as a partnership. It's going to be taxed based on what distributions are being made to the beneficiaries out of the gross income and D&I and all those different acronyms that we won't go into in too much depth today. It's basically being split between the trust and the beneficiaries, the income. taxable income is usually computed in the same manner as individuals. But the key thing is that individuals usually fare much better under the tax code. So let's explain exactly why. This one slide is the main reason. It's the compressed income tax brackets for trusts. So we've got, last year, well, it's basically roughly the same this year, 2018. You hit the highest tax rate at $12,500 of income. Now, they deviated somewhat for capital gains, but it's pretty close to that, actually. And so we've got 37% tax rate once I get above that $12,500. Now, for individuals, remember, it's $600,000 for married filing jointly, $500,000. So that's a big discrepancy, right? Most of us in this room are not in the highest tax bracket, probably. Now, there's a few, Chris Fout, being a new attorney, she's going to make a lot of money. I'm sure she'll be in that $600,000 tax bracket pretty soon. But most of us probably don't make that. But we all make over $12,500, hopefully, right? And so this is the key difference. If I'm having income in the trust, it's going to be taxed at a higher rate. And we'll talk about some other discrepancies and disadvantages as well in a few minutes. But to get the fundamentals, the net investment income tax also applies to that same compressed bracket. So if I've got, remember, for individuals or married filing jointly, that hits at $200,000 or $250,000 AGI roughly. So if I have a trust and estate that makes $20,000, not a whole lot of money, but it's going to get hit with that 3.8% surtax, because if it doesn't make any distribution to beneficiaries, anything above that $12,500, $7,500 in my scenario here, is going to be taxed at the highest rate, which is going to be 37% plus 3.8% if it's net investment income. If it's capital gains, it's going to be the 20% plus 3.8% plus Idaho, if we're talking about an Idaho trust, 7.4% potentially as well. So we also are hit with higher AMT. There's less AMT exclusions for trusts than there are for individuals. Doesn't come into play too often. But the key thing is it's almost always going to be higher tax, being taxed to a trust than to individuals. So in our income tax categories of trust, the terms that I'll be using today, grantor trust, it means it's taxed to the grantor. So our garden variety revocable living trust, it's a grantor trust. It all goes on the grantor's 1040, right? At least until they die. Then it becomes a non-grantor trust. A non-grantor trust is taxed as a separate taxpayer. There is such a thing as a part grantor and part non-grantor trust, and we'll go through some examples of that. If I had a 5 and 5 power over a trust, that would be a 5% grantor trust. He has the power to withdraw 5%. And we'll talk about some differences in partial grantor trust a little bit later, but in a nutshell, I'm going to use this dichotomy between grantor and non-grantor trust here today. So the grantor trust provisions, let's see how we get under those. We're probably familiar with, most of you, irrevocable grantor trusts and ILITs and any, slats, all those kind of things are typically going to be grantor trusts because they have provision for a spouse or they have powers that the grantor keeps. That's where I'm triggering that 673 to 679 of the tax code. If it's a spouse, there's spousal attribution as well. And those are going to be taxed to the grantor, the beneficiary as well. If it's a grantor trust, we're not necessarily filing a separate tax return. Sometimes you can. There's a 1041. You can check the box for grantor trust, but most people just report it directly onto the the grantor's tax return. So we know there's some common examples you guys are familiar with. Most of the living trusts that we set up are GRATs. They're going to be grantor trusts. IDGITs, SLATs, all those kind of things. CUPERTs are going to be grantor trusts because the grantor is keeping certain powers and rights to the income, or their spouse is, one of the two. If the beneficiary has a right to amend, revoke, or withdraw corpus, that's where we're triggering 678. So generally, irrevocable trusts that we set up most of the time, and this has been the kind of the paradigm for years and years, are going to be grantor trust. There may be some circumstances where you'd want to set it up as a non-grantor trust for certain reasons. Maybe I want to get more 1202, capital gains tax exclusion for a business sale, or maybe I want to come get better charitable tax deductions. There's an article linked to on this slide, and you'll get the slides by email from Tom, I think. So you can consult these later, but there's a link to an article about that. Okay, so that is a basic introduction. Let's get into how 678 works. It's not a really long code section, the part that we're going to talk about. And since it's really short, let me just read it. The general rule is that a person other than the grantor is treated as the owner of any portion of the trust with respect to which that person has a power exercisable solely by themselves to vest the corpus or the income therefrom. And we're only taking just section 1 here first. So I want to explain the power over corpus first before we get to the power over income. The power over corpus is if John Doe dies and he leaves his assets to his wife in a marital trust and gives her the power to withdraw the corpus. That is a grantor trust as to the power holder, the wife in this particular instance. Another situation that you may run across that might be not uncommon. Somebody dies, they leave assets into trust for their kids, and it says pay out at age 30, 35, and 40, and it gives them the power to withdraw 100% of the assets at age 40. John dies, they're age 49, 50, whatever. Now they've got the power to withdraw the entire corpus of the trust. Even if they don't, even if they leave it in there, it's still taxed to them under 678 of the code. So it's taxed to them no differently than if they just had it in the revocable living trust. It may not be the same for asset protection purposes, and we'll get to that in a little bit later. But let's tackle this power over income now. Now, we don't usually draft powers over the entire corpus of the trust, right? I mean, this kind of destroys the whole purpose of trust. It destroys the asset protection for the most part. It destroys the bloodline protection. And, it's probably, if somebody's got the power to withdraw all of the corpus, there's no real protection from the in-laws in a divorce situation. All those reasons that we typically set up trust, it's all in their estate under 2514 of the code. There's not much benefit to having a trust drawn up this way, frankly. Okay, so that we don't see it very often. Now, what if we drafted a power over only income? Because 678 not only talks about a power to withdraw the corpus, but it talks about the power to withdraw income. So here's the second part of that particular paragraph. Let's go on to that paragraph here. A person other than the grantor is treated as the owner of any portion of the trust with respect to which that person has the power exercisable solely by themselves to vest the income in himself. And they're using these. But basically, if you've got the power solely exercisable by yourself to take all the taxable income out, that also triggers out 678. When it doesn't even reference principal or corpus. So if I don't have the power to withdraw all the corpus, but I have the power to withdraw all the income, 678A is triggered as well. So let's walk through. We've got John Doe dives these assets to his wife in a marital trust, grants her the power to withdraw annual income. Same thing, if I set up a trust for kids, I'll give them the power to withdraw all income annually. But to understand the effect of this, how is income defined? And so we have to back up and kind of understand how the definition of income differs a little bit under fiduciary principles, the Trust Principal and Income Act, and the trust agreement, and under 678 of the code. Let's parse through a little bit of how this works, because understanding this gives us the ability to manipulate a lot of the trust income how we want it. So income has different meanings under the code. When you talk about the grantor trust section, which includes section 678, the regulation here that I put in bold is basically saying when the IRS and Treasury Department is saying, when we're talking about the word income in these code sections, we're talking about taxable income. So that includes capital gains, okay? We're talking about any gross taxable income. So if you had the Principal and Income Act that says part of an IRA distribution is income and part is principal, that's irrelevant to this definition of income. This definition of income just means whatever's, we normally think of as taxable income. So this is actually easier for clients to understand. If I've got a 1099 or a K1 or a W-2, that's income. That's how we normally think of taxable income. That's how lay people think of income in many respects. So is it something that I have to pay tax on? That's taxable income under the grantor trust rules. But the document, when I give my wife the power to withdraw income, might mean something different unless we define it otherwise. So this is where I get into a little bit of the basics of trust accounting income and the Principal Income Act. This concept of accounting income versus principal is still kind of important. It's anachronistic if you've got a trust that's discretionary distributions or unit trust, but it's still really important to understand this for income taxation of trust. When the trust document says income, if it doesn't define it otherwise, income means fiduciary accounting income, which would be interest, dividends, rents, maybe only a portion of an IRA distribution. It could mean non-taxable income too. If I get muni bond income, if I've got a Roth IRA distribution that's not taxable for federal purposes, it's still considered income for trust accounting income, right? For fiduciary and accounting income purposes, it's still considered income. And if the trust document says so-and-so can withdraw the income, that includes muni bond income, it includes a Roth IRA distribution that's not taxable income. So we've got a little bit of a crossover. If you imagine a Venn diagram, the definitions are kind of overlap, but they're not the same at all. So the definition of income in the rest of the code, in other words, the non-grantor trust rules, means accounting income. Okay? But for the grantor trust purposes, it means taxable income in general. Now, let's go through how we make this work in a practical example, this different definition. We've got these two examples that I went through earlier. If income under the document means accounting income, then 678 of the code only applies to that portion of the trust. So if I've got to set up a trust for my kids and I say, kids, you can withdraw the accounting income, how much is taxed to them, whether they withdraw it or not? The accounting income only, so interest, dividends, rents, not capital gains. But I could define income differently under the document. I could grant my kid or my spouse or whoever is the beneficiary of the trust, I can give them the power to withdraw all taxable income. And that shifts the taxable income to them under 678 of the code. Now, this drafting the trust in a little bit different way with the withdrawal power over the taxable income, this is what I call a beneficiary deemed donor trust under 678 of the code, a BDOT, to use my acronym. So if I'm granting somebody the power to withdraw all the income, they don't have to be granted any power to withdraw the corpus. So if I've got $1 million corpus and the income happens to be $50,000 during the year, the beneficiary under this such clause would have the power to withdraw $50,000, not the power to withdraw $1 million. So you still got the asset protection over the corpus, the $1 million is protected just as it is in any other trust. You just don't have the asset protection over that $50,000 withdrawal right that you would, but many people would be fine with that. Kind of depends on the situation. Am I going to give my son, who's a drug addict or whatever, this kind of power? No. Is it applicable to a special needs trust where I may not want to give this withdrawal power? No, it's not going to work very well there. If I want, if I'm on a second marriage situation, and I want the maximum amount to go to my kids and the minimal amount to go to my second spouse or whatever, no, I'm not going to use this because I could use a Q-tip and only grant my wife the power to withdraw accounting income. I wouldn't have to, give her the right to withdraw all the, entire taxable income of the trust. So if I wanted to preserve more principal for my children, I wouldn't use this provision. But absent that, those kind of situations, many of your clients would be fine with just granting a power to withdraw taxable income. Okay? Let's go through the effects of what that means to the family, because this may be, in many situations, a much better result overall. So, some of you might be a little bit skeptical. So what I did in the research is I found the case law behind this and the regulations as well. So let me just, before I go through some more examples, just go through a little bit of the case law. The main case that you'll see cited in treatises is called the Malingrock case, if I'm pronouncing, I may be butchering the name. This actually predates Section 1678 of the Code. In fact, you'll see this in treatises referred to as a Malingrock trust, is what I call a BDOT trust, or a 678 trust. In this particular case that Congress basically cited and used as a template for putting 678 in the code, what happened was the dad had established a trust for his son and his wife, and the son's wife. And the wife got he really wanted to kind of protect the minimal amount accessible to the spouse, to the son's wife. He granted her the right to $10,000 a year. And then he had the trust where the son could withdraw any income above that $10,000. Now, the son didn't take any money out of the trust. And the issue for the court was they filed the return as if the trust was owed all the tax on the income. And the son said, that should be the case because I didn't withdraw any of the money out. And the IRS said, and they won the case and went to the, 8th Circuit here. The court said, you know what, he could have withdrawn all the income, and so you're going to be taxed on it. If you can withdraw all the income, you're going to be taxed on it. That's basically the gist of it. So what would happen in this particular case, the trust was a non-grantor trust as to the $10,000. It got a distribution deduction for $10,000, and the wife paid the $10,000. Just like normal trust principles would, right? The rest of the income, though, wasn't taxable to the trust at all. It was taxable directly to the son. Now, they didn't really talk about capital gains and these issues, but there is a case that came afterwards, the Campbell case. And in that particular case, the beneficiaries had the power to withdraw all the income, specifically including capital gains income, and they didn't pay the tax on it. So what did the court say? What did the IRS say in the tax court? The beneficiaries had to report the capital gains withdrawable under 678 of the code. Regardless, again, this operation works regardless of whether they take out a dime. It's still taxable to them whether they take it out or not. And this can be important. So it's not optional. You can't just report it to the trust and as an option, report it to the beneficiary. The beneficiary has to report the income. There's also a recent private letter ruling where, and this was just 2016, and this was kind of an odd ruling request, but you had a trust that was a non-grantor trust actually establish another trust. Now, trusts can actually establish other trusts. It's kind of odd. You don't see it every day, but it's got its applications. In this one, what they did was they wanted the income in this second trust not to be taxed to that trust, but to be taxed to the first trust. So they drafted in a provision, just like the one I'm talking about here, where the trustee of the first trust could actually withdraw all the taxable income of the second trust. And they got a ruling that basically said, just like the Malindrach case and just what I was talking about here, that if the trustee of Trust 1 can withdraw all the taxable income from this other trust, it's all taxable to trust number 1. Okay? The nutshell is income is taxable to the person who has the power to withdraw it. Okay? Unless it's overridden by one of the other grantor trust code sections. Now, in most of the cases that I'm dealing with and talking about here today, though, we're going to assume this is somebody setting up a testamentary trust after their death. Well, then the grantor is dead, so that no other grantor trust provision could apply. So it's either going to be a grantor trust under 678, or it's not going to be a grantor trust at all. Okay, if the grantor is dead. So this PLR, it's not citable precedent, et cetera, just like we always say but it does tell us a little bit how the IRS is viewing this issue. I don't think there's anything wrong with that particular ruling, although I wouldn't copy the language in the ruling because I think there was a kind of a quirk. They kind of missed something. I would draft it in a little bit different way. But here's what we've got in a nutshell. We've got this power withdrawal where we can shift the income to the beneficiary. Let's go through. It could be a part grantor trust, actually. If you only gave the power to withdraw half the income, it might actually be based on divided between non-grantor and grantor trust status based on a fraction. Actually, you could have, if you wanted to be creative, I wouldn't suggest this in most cases, but if I granted the power to withdraw the income from XYZ stock, okay, then all the dividends and capital gains and distributions, et cetera, attributed to XYZ stock would be attributed to that beneficiary, but not the other assets in the trust. Of course, if I only get granted the power to withdraw accounting income, the trust could be divided between a grantor trust as to accounting income, a beneficiary deemed owner trust, and a non-grantor trust as to the capital gains or income that's attributable to corpus. So we can have a part trust. Let me just give you one example of how this could be manipulated. I'm not sure, but just like the Mallinckrodt case, what if we had a provision that perhaps paid $10,000 a year to charity? Maybe it was a trustee spray power. More likely it's going to be a lifetime limited power of appointment that you grant to the family. And I distribute $10,000 to the family's donor advised fund and grant the spouse or the other beneficiary the right to withdraw all the income above that. Well, just like the Mallinckrodt case, the $10,000 is taxable to the trust. You get a 642C deduction going out to the charity. No income there. All the rest is taxed to the beneficiary. Why might this be more palatable to people? Why hadn't people thought about this before? Why is this important? Because the middle class doesn't get a charitable deduction anymore. Now, maybe you guys in this room are a lot more charitably minded than me, and you give $24,000 or more a year, but I'm not going to get a charitable deduction this year. I give a little bit to charity every year, but with the standard deduction, $24,000, I'm not going to have enough itemized deductions now because most of the itemized deductions are wiped out. State and local income tax deductions are limited to $10,000, right? Unless you have a super huge home, even with that. Most of the middle class isn't getting a charitable deduction anymore, right? Now, maybe you could use an IRA if you're over 70 and a half and get the deduction that way indirectly. But most of us in the middle class and most of your middle class clients aren't getting a charitable deduction. But non-grantor trusts get an above the line deduction. So it's pretty cool. So if you had a family that was somewhat charitably minded, but not giving huge amounts, now uber wealthy families, they can give to over $24,000 and they're still going to itemize. But for people who are giving $5,000 or $10,000, here's a way to, if I set up non-grantor trusts, I can get the charitable deduction for the non-grantor trust and have the rest of it taxed to a beneficiary. Okay, so think about that. That might be a way to, an additional benefit to establishing trusts such as this, but you do have to have it set up as a non-grantor trust to start with and then add the withdrawal power to whichever beneficiary you'd want to get the excess that's not going to charity. So that's kind of an interesting nuance, I think, of this, where you can have a part grantor, part non-grantor trust. Why would you want to do that? There could be some instances there. By the way, this could be toggled on and off. If I have a power to take away that power withdrawal right, you could grant that to a trust protector or to a trustee or some other party. You can manipulate that. Why would you want to do that? Well, if somebody's in a top tax bracket in a given year, but usually they aren't, maybe you want it to be a non-grantor trust in that particular year because you can avoid state income tax. Right? It's pretty easy to avoid Idaho income tax in many cases if you have a non-grantor trust. But that doesn't do you any good if the beneficiary's in a much lower tax bracket. If the beneficiaries are all in the highest tax bracket, that actually has some benefit. So anyway, let me get to the, where I see the most universal use for this, for middle class clients, and what the effect of this is. So a couple more examples before I go through the big differences. Here's an example that I thought would be useful. If I have a power to withdraw a portion of the corpus, you would have that'd be a part grantor, part non-grantor trust. So it's not uncommon. How many of you actually draft trusts with the 5 and 5 powers? Anybody here actually draft trusts that way with the 5 and 5 power? Once or twice, a gentleman here. It's not an uncommon provision. Sometimes beneficiaries kind of like that, spouses might like that. They say, well, we know they can at least get 5% no matter what the trustee says, and that should avoid a lot of arguments over how much they should get as a discretionary distribution. In some respects, the 5 and 5 powers are a bit messy for trust accounting purposes because it makes it a part grantor trust as the 5% and a part non-grantor trust, okay? Now, I could grant the power to withdraw the greater of taxable income or 5%, and that would shift all the taxable income, not just 5%. And that might be a lot smoother from an accounting perspective and get you additional benefits that I'll talk about on the next slide. So here's the big differences. If I'm a fully beneficiary deemed owner trust, taxable under 678, so it's all taxed to the beneficiary, that's just like revocable living trust where we can report it all on our 1040, right? It's all taxed to that beneficiary. We don't have to necessarily file a Form 1041. Now there's an option to. I mean, you can check the 1041 box and do a simplified 1041. The biggest thing that we're getting around, though, is those compressed tax brackets, right? So I'm not getting hit in that, once I get above $12,500, I'm not getting hit with that highest tax bracket for ordinary income, capital gains, net, AMT, all that. Also, you have an issue that even if I would distributed all the income in a non-grantor trust out to the beneficiary, sometimes you've got phantom income or capital gains trapped in the trust. That's the default rule. And we don't have that problem when we have this power of withdrawal right. So the other thing is these trusts are kind of leaky from an asset protection standpoint. Because of the compressed tax brackets, people are basically prevailing upon the trustee to pass out all the income, at least close to all the income, to avoid these highly compressed tax rates. So there's a lot of pressure on whoever the trustee is to pay out all the income anyway, and that takes it out of the asset protection realm of the trust. By contrast, if we grant a withdrawal power, nobody has to take a dime out of the trust to shift the income tax. So even though it sounds like it's not as good for asset protection, and we'll go through a couple more examples, it may actually be, in the long run, better asset protection. And I'll go through that in a minute. So you've got some tax deductions and benefits that are lost when I'm a separate taxpayer. Some of these we may not be as familiar with, but they can be really valuable to a lot of our clients. And some planning techniques are lost by having a separate trust taxpayer status. Installment sales to grantor trusts. How many people set up installment sales to non-grantor trusts? Nobody? Well, that's because it's a taxable event when you do that. When I sell and buy assets with my non-grantor trust, it's considered a different taxpayer. I'm triggering tax. When I do transactions with my beneficiary deemed owner trust or grantor trust, it's a non-event. I can swap assets back and forth, and that may be very advantageous for income tax purposes down the road. So what are these differences that I talked about that could be really valuable that we're avoiding with the BDOT that, that are really problematic for non-grantor trusts? How many of you work with business owners? Okay, that's most of you, okay? Don't they all talk about getting this juicy 179 deduction at the end of the year? Yeah. See, they're like, oh man, if I could just buy another backhoe or some more equipment or whatever, I get an immediate expense deduction under 179 of the code. Up to, it went from 500,000, it was 25,000, went to 500,000, 510,000 with inflation, now it's $1 million after tax reform. How much deduction does a non-grantor trust get? Nothing. Nothing. It doesn't get it. Under 179D of the code, this isn't available to non-grantor trust and estates. It's kind of a raw deal, right? So if you're setting up a non-grantor trust and you're doing business succession through non-grantor trust, which would be very not uncommon at all for a larger company to be using trusts and a dynastic trust and such to pass down the family business and trust. If you're using a non-grantor trust, which most people do, you're losing this 179 deduction. But if I put in a BDOT provision, guess what? It's all being taxed to the grantor, and under 179, it's just ignored. Under 8513, a beneficiary deemed owner trust, grantor trust are ignored. So the 179 deduction passes through right to the beneficiary. Okay? That's huge. Imagine if you had a partnership, an LLC, and the trust owned 50%, and they went out and they bought $1 million worth of equipment, and $500,000 deduction could have been expensed to the trust, but it's not. How much extra tax is that causing? That's a big, big number, potentially. The other thing that affects almost all of your clients, okay, How many of your better clients own homes, right? All of them, okay? Now, not every home goes into the trust, but sometimes people are kind of forced to put the money in the trust. If that's most of their wealth, they're going to put the home in the trust, or at least half the home in the trust, because that's what you need to do if you want to protect that from asset protection purposes, bloodline protection, and all that. So inevitably, you're going to have some of your clients have the home go to the trust. Some of them, of course, are going to just have it go outright, but it's still very common to have the trust go into, or the home go into the trust, and a non-grantor trust loses the $250,000, $500,000 capital gains tax exclusion. They don't like that, right? You know, when the widower comes to you and they have to sell the home and move into a nursing home or something like that, and they come to you and you tell them, oh my gosh, we're going to have to pay, 20.3, 23%, 30% with Idaho tax on this, sale of this home because you lived in the home for 8 years and afterwards, and there's all this appreciation after your husband or wife died. If you could have made that a grantor trust, if you put a clause in the trust that says to the spouse or whoever the beneficiary is, it could be a non-spouse, you've got the right to withdraw the capital gains from the result of that sale, then it's deemed to be a beneficiary deemed owner trust as to that asset, and it would get the Section 121 capital gains tax exclusion. That saves a boatload, right? Also, you've got different rules for charitable deductions. Sometimes the charitable deduction rules are better for non-grantor trust. Sometimes they're better for individuals, so it's kind of a mixed bag. I don't put that as a really big advantage, but sometimes it can be. This is a new one. I was talking to Tom earlier. He just went down to San Francisco and went to an all-day event with Deloitte just on 199A. Can you imagine how dull that would be? Oh my God. Just the regulations on 199A were like 184 pages, It's just crazy. But it's a pretty juicy deduction, right? Let's see, how could we possibly use trust to manipulate the client's income to get a better deduction? In some cases, we know that this income tax deduction is capped, right? So it could be based on, I don't want to go through all 199A, because that could take another 6 hours. But remember, if you're a specified service business, there's a particular cap. That's attorneys, accountants, engineers. It'd be a lot of other businesses too. I just found out that like professional ball teams are in that category, and I was researching that for a particular client. So we know that there's that cap. And if you make over $315,000, if you're married finally jointly, or $157,500 if you're single, that deduction starts to fade away. And once you get above $50,000, $207,500, or $415,000 if you're married finally jointly, the deduction may completely go away once you get above those amounts. But these are going to be a lot of your better clients. Remember, those taxable income includes all the non-business income. So if I've got a husband with their own business making $200,000 and the wife who's got a W-2 income of $200,000, their taxable income is $400,000, okay? So that cap is not based on the business income. That cap is, those thresholds are based on total taxable income, okay? So it's easier than you think to actually be hit with those thresholds. Now, what if I want to do some business succession planning and I want to start devolving some of the ownership of my business to my daughter, for instance, who's going to be in the business with me, and I want to devolve the ownership of that business to her? Well, the new proposed regs that came out in August are actually very antitrust. There's several different provisions in there, and I'm only going to talk about two because it's 184 pages, monstrosity. Let me just go through an example of what these new proposed regs do. Now, whether they can get away with it, that's another issue, but let's just assume the proposed regs are made final as they are. I give some LLC interest to my daughter. I'm going through the example here. The trust makes $250,000 gross. So it's getting a K-1 from the LLC. We'll assume it's a partnership at first, $250,000. If the trust distributes $100,000 to the daughter, what's the taxable effect? The taxable income you would think to the trust is $150,000. And that's going to be the net on the 1041 after the distribution deduction out to the daughter. But the proposed regs say, you know what, for 198 purposes, we're going to just ignore that distribution that you made, and we're going to count it as if the trust had $250,000 of taxable income. That's over the threshold. If it's a specified service business, you get no deduction. So, boy, that kind of, prevents us from using non-grantor trusts to get the benefit of this deduction, doesn't it? In many ways. If it's an SBIT, it's even worse because the $100,000 might get the 199A deduction that passes out to the daughter depending on the daughter's income. But for an SBIT, an SBIT is an electing small business S corporation trust, and there's no distribution deduction for an SBIT, so all $250,000 is taxable to the trust, and you don't even get a distribution deduction. So also, under the proposed regs, they have this particular clause, and I'll just quote from it real quick. The regs have an anti-abuse provision under 199A that you can deny the deduction for trusts formed or funded with a significant purpose of receiving a deduction under 199A. How do you determine what a significant purpose is? How do you determine whether somebody formed it for that purpose? If it just happens to, if you set up a trust for, how do I prove a negative, so to speak, to the IRS? I don't know. I think the regulation is not very workable. I was part of an ACTEC committee with a couple of other guys, and we submitted comments to Treasury on these proposed regulations on these 2 points, on this in Section 643 of the code, the multiple trust rule, and we gave them lots of examples that would help clarify and not be quite as abusive, but whether they'll listen to us or not, I don't know. We'll see. But the key thing is, don't necessarily want to count on being able to use non-grantor trust to still get this 199A deduction. But how are grantor trusts treated under 199A? Well, they're ignored. It's basically the income is going to be attributed to the grantor or the beneficiary deemed owner under the grantor trust rules, and we look to whatever that beneficiary's income is. So in my example, if I had this particular trust and I granted my daughter the right to withdraw a certain amount of the income, how is that treated? Well, it might be treated much, much better because, again, any income that is withdrawable by my daughter, whether it's $100,000 or $250,000, is taxable directly to her. So if her income tax threshold, if she's married finally jointly and she's making under $315,000, for instance, she's under that threshold, you get the 20% 199A deduction. If we let her withdraw $100,000 and you kept $150,000 in the trust, presumably the net income to the trust is now even, $150,000. It comes under the threshold, and the trust would get the 199A deduction as well. Could they use the anti-abuse rules for grantor trust? I don't think so, because it's very specific in the proposed regulations that grantor trusts are basically ignored, and the citation for that's in the white paper. So I think we could use this to, particularly for specified service businesses, if we're using this trust to basically shift the taxable income to the beneficiary, just as if we had gifted the stock directly. But what's different here? If I gift the stock directly to my daughter, is there any asset protection for it? No. Is it in her estate 100% for state tax purposes? Yes. Could it be subject to divorce? Could it become marital property, et cetera? Well, maybe if she commingles or has an agreement, transmutation agreement and things like that. But it's subject to her creditors too. Whereas if I use a trust, I got all those benefits of the trust, right? I can make it a dynastic trust, keep it out of her estate, have it go to her kids, not to her husband. All these advantages I can use with a trust. Also, it's much better from an asset protection standpoint we'll get into in a few minutes. So, using this type of trust where I basically, and remember, if I set this up inter vivos, in other words, I'm still alive, I set this up for my daughter now during my lifetime, I have to make sure I'm probably not going to be a trustee. I'm not going to keep powers that would make it a grantor trust as to me, okay? So I can't be a beneficiary of the trust, or my wife as a beneficiary of the trust, unless I had a consent of an adverse party, which gets a little bit more complicated. But if I avoid those grantor trust rules and I give my daughter the right to withdraw a portion of that taxable income, I just transferred the taxable income and the taxation of that to my daughter. So you can see where this might lead to a lot of advantages. Not only do we have the ability to get the 20% deduction, but what's her tax bracket very likely in most cases? Lower than mine, right? And lower than the trust would be. So overall, not just for the 199A purposes, but for other income tax purposes, shifting the income to that beneficiary is very advantageous overall. Now, the other thing that people will say, well, geez, doesn't this resemble a lot like a crummy power? It does, doesn't it? In the real world, how many people that are crummy beneficiaries ever actually take the money? Anybody ever here the crummy case is 50 years old. Yeah, you had one case where somebody did that. Yeah, they probably didn't do it the next year though. Yeah, but the crummy case has been around for 50 years. So, and the IRS contests these all the time as fraudulent, blah, 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 blah. And there the issues are a little bit different. We're talking about annual exclusion gift under 2503, not 678. But there's a lot of jurisprudence that, by the way, it shifts income tax even if it's a minor, and that's Revenue Ruling 81.6, basically. If I give a withdrawal power even to somebody that's incompetent, okay, it still shifts the income taxation to them. Okay, and in 81.6, the court basically concluded, or the revenue ruling concluded, well, they could have gotten a guardian appointed or something like that, so we're going to still deem it taxable to them. Okay, so it's taxable to them, even if it's a minor, it's taxable to them. Now, of course, you have the kiddie tax rules, though, so you can only do so much with income tax shifting to minors, right? But if you get around, there could still be some advantages to that. So let me walk through a couple of the other differences and that maybe are just kind of overlooked, some disadvantages to non-grantor trust. The S corporation qualification, you can be a beneficiary deemed owner trust. As long as it's 100% beneficiary deemed owner trust, it's taxable to the beneficiary. It's an eligible S corporation owner. As long as it's not a non-resident alien, if you're a U.S. citizen beneficiary that you're dealing with. And you can have an ESBN election over such a trust, and that could be important if you ever have a forfeiture or assessor clause that we'll talk about in a minute. If you make an ESBN election over such a trust, over a grantor trust, the ESBN rules are kind of ignored. They're in stasis, so to speak, until the grantor trust status ends. Okay, or if you only have a part grantor trust status, it would only apply over the non-grantor trust portion. There's also some disadvantageous rules under life insurance for transfer for value rules that come into play, and annuities also have some disadvantageous rules for non-grantor trust because you're not really an agent for the insured, and you can't. And so, if you can make it a see-through trust as to the beneficiary, sometimes you can get more advantageous rules under the transfer for value or annuity rules as well. So. We don't deal with a lot of annuities inside of trusts and things like that very often, but if they ever come up, that could be something interesting. If the beneficiary is active in the business, if you've got somebody that's making a good business where you've got the 3.8% surtax, remember that doesn't apply to people who are active in the business. So if you've got a business that's making $1 million, and let's just take the simple case, it's 100% owned by the patriarch, that set up the business. Is he paying any net investment income tax? No. Active in the business, it's not net investment income. If you start to do some business succession planning, I put in the trust in, or maybe patriarchs died, the stock is in the long-term non-grantor trust. Is the non-grantor trust deemed active or passive? Well, there's been a lot of litigation around that. The IRS position is extremely stringent. They're going to consider that passive under most cases, even if the co-trustee is active in the business, potentially. The nutshell is it may be stuck with the 3.8% surtax for the business income. because the trust isn't sufficiently active in the management of the business, okay, or in the business itself. Now, there's 2 court cases, the Frank Aragona and the Matty Carter cases, where they put a chink in the IRS armor. But the IRS could come out with new regulations that close that down pretty quick if they wanted to. Nutshell is, if you've got a beneficiary deemed owner trust, how is the net investment income tax passive active determined? Well, you look to whether the beneficiary is active in the business. Are they employee? Are they working in the business? Okay. You know, if they're co-owner and such like that, then I avoid the 3.8% surtax. Whereas we're really under very uncertain rules. Now I could, you know, I've set up trusts where we have a non-grantor trust, and we tell clients, well, you may be able to get around the 3.8% surtax if you name an active trustee, co-trustee. And we've had a couple cases, you know, where the corporate trustee is a co-trustee with somebody active in the business. And the hope is that avoids the 3.8% surtax, but it's really unclear if you read the IRS Field Service Memorandum and their take on things. They did not acquiesce in these 2 particular cases. So again, it's another example of, there's another case where a beneficiary deemed owner trust is probably a lot more certain and could save some more tax, provided, of course, the beneficiary is active in the business. Also, in some scenarios, you could have multiple states' taxation of a non-grantor trust. So if you set up a trust for the family and you set up co-trustees and you got 1 trustee in Oregon, 1 trustee in California, you know, and if you weren't wise enough to name U.S. Bank or Key Bank as a trustee, right? You know, what's the taxation effect of that? You may be paying tax in 3 states, right? And under the constitutional law, do you have to have a credit there? No. You know, now you can make an argument under the Wynn case and things like that, that due process, et cetera, but there is constitutional jurisprudence that because the trustee might be deemed a resident of multiple states, it's not like, you know, I'm working in a different state and the state has to give me a, you know, credit, like the Wynn case was. You could be stuck with multiple states' taxation. Whereas it's a lot simpler. If I've got a BDOT, it's just taxed to wherever the beneficiary resides, okay? A lot simpler. I'm avoiding the potential for multi-state taxation. You know, when people move around about, that's something to pay attention to. So that's another potential advantage. Grantor trust, a QTIP can be a beneficiary deemed owner trust as well. Remember, the QTIP has to pay out the mandatory accounting income to the surviving spouse. Little known, but not used as often, I could also grant the surviving spouse the power to withdraw at a minimum, the accounting income. That also qualifies as a QTIP. So if I grant my spouse the power to withdraw all the accounting income plus any income attributable to principal, okay, meaning all taxable income, all the income would be taxed to my surviving spouse, not as a separate trust. So I could have a QTIP also exploit this provision, and this could be advantageous if I had GST allocated to it. So if I'm setting up, in this particular example here, you know, I've got John, he leaves $10 million estate to his wife Jane in a QTIP trust, and he's got a reverse QTIP election, you know, because the GST doesn't port, right? You know, the 10 million, 11.18 or whatever it's going to be at the time, GST exclusion doesn't port like the DSU amount does, right? So we want to use a QTIP to allocate that, or you could allocate it to a bypass trust. But in this example, it's a QTIP trust. And we're going to use the GST exemption. Jane's got a big estate of her own. We're talking about pretty wealthy clients here. Here's the scenario. If we generated 4% and 3% realized growth over time, and we went out 10 years, let's say the surviving spouse outlives by 10 years, the GST exempt QTIP would grow to about $13 million over that time. I'm just using rough numbers. I'm not doing something like a financial planner would do on this. But let's contrast. If I gave Jane a withdrawal right over the income, so it didn't force out the income, okay? So she pays the tax on it. You know, she pays it out of her own funds, okay? The QTIP trust that's GST exempt is growing more. It's the same concept as we use with IDGITs, right? If you're paying the tax on the IDGIT, isn't it growing more than if you'd had a non-grantor trust? So this same concept works with the BDOT. If I grant the surviving spouse the power to withdraw all the income, as in this particular example, the GST-exempt Q-tip trust is going to grow more than if I didn't, okay? So that's just another aspect of this that, you know, again, I think this has the most application for, you know, the vast swath of just the ordinary middle class that wants to avoid fiduciary income tax treatment. But you can see where we could use this even for our higher end clients as well, because now we have a disregarded entity, right? Okay, so let's take another couple of examples. Jane inherits $10 million into a BDOT trust, okay? In other words, it gives her dad or mom or whoever set up this trust for her, gives her the power to withdraw all the income. Now, we know under 8513 revenue ruling that sales between a trust that's deemed 100% to be taxable to the grantor, the owner, are ignored. You can't have a sale with yourself be recognized under 8513. So what if she is super wealthy and she sells a portion of her, or maybe all, of her $80 million company to her BDOT in an installment sale at the AFR rate? Aren't we doing leveraging just like we are with installment sales to IDGITs? But here, Jane's still a beneficiary. It's even better, you know? Even better than an IDGIT type sale, because Jane gets to be a beneficiary of the trust, okay? So this is like, I know Stacy Eastland and Steve Akers talked about BDOTs at a couple of the last meetings, and they're going out and talking about these. And of course at Goldman Sachs, you know, this is the kind of stuff that they talk about rather than the other stuff. But, you know, you can see where the super wealthy could use these kinds of trust as well. And, you know, under a lot of liberal trust construction statutes and uniform trust code and things like that, you may be able to amend a trust. So let's say Jane inherited a garden variety trust that said, pay income plus health, education, maintenance, support. Let me just hear this from you under Idaho law. How likely is it if you got the trustee and the beneficiaries to agree that a court would convert that clause to a trust that gives the beneficiary the right to withdraw all taxable income? Anybody want to give me some odds? What do you think a court would do? Anybody think a court would not approve it? I didn't hear anybody say yes, no. So I'm going to get from that if you tell the judge, here's why we're doing this, beneficiaries are okay with it. Now, you may not get the remainder beneficiaries be okay with it if it was a super stringent trust, you know, the remainder men may balk. But in most family scenarios with a really liberal distribution provision, are you really impeding or impairing the remainder beneficiaries' interest? Not really. In fact, in many cases, you may be augmenting it, because what you've done now is, in many scenarios, the older beneficiary, Jane here, is setting this up to benefit her kids. By her paying the tax on the trust, it's benefiting the remaindermen, right? So they're going to be fine with it in most cases. So again, if you've got, you know, the IRS is generally going to honor amendments to irrevocable trusts that are prospective. So like if you go to court and you botch the marital deduction, or you didn't draft the charitable remainder trust right or something, they may not always honor it retroactively at a court reformation. But when you get a reformation where the court says, and as long, of course the IRS would follow this if they think that the highest court in the state would basically follow the trial court. If you amend a trust prospectively, you've changed the beneficiary's rights, they should basically honor it the same way. Now, if you tried to make it retroactive, I couldn't guarantee that would work. So any kind of amendment like this would probably be easiest to do as of January 1 of the next year, probably, you know, or at least cut off mid-year or something, just so the accounting's a bit easier. So what if I had a trust that's going on and there were some trapped capital losses? I had this case once when I was in private practice where it was just a bad real estate deal. the real estate market in this particular town tanked, and they sold a property for like a $300,000 loss. And the trust was ongoing. And one of the benefits of terminating a trust or terminating non-grantor trust statuses, you're unlocking the $300,000 of capital losses. Because how are capital losses used in a trust? Well, just like everybody else. You know, you can offset them against future gains. In this case, there was very little gains. It would take 50 years. Actually, it was more than 300,000 now that I think about it. But here's the nutshell. When we terminated the trust early, all the capital losses get to go out to the beneficiaries, and they get to use them against their own capital gains and losses and $3,000 a year against ordinary income. So if you had a case where capital losses are trapped in a trust and you convert it to a beneficiary deemed owner trust, what happens? Well, the trust, as a non-grantor trust, is terminating. There's going to be a final K-1 out. And remember, capital losses go out on the final terminating K-1. So you can unlock capital losses in this way. You know, some deductions may not necessarily pass out, but there's some proposed regulations under the Section 67 that are coming out too, so that may be advantageous as well. You just might want to be careful with certain fees and such like that as to when you do that. But the big number is probably going to be the net operating losses and net passive losses and net capital losses that could pass out. I mentioned here distributions in kind, and here's another reason why you might want to amend a trust. Let's say you had a trust that says at Johnny's 40th birthday, pay out $1 million. Okay. Now, if you give $1 million cash, there's no particular tax issue going on. But what happens if you don't have $1 million cash and you give Johnny Blackacre, or you give Johnny some mutual funds that have been appreciating over the years? Under the Keenan case, that triggers the tax on the $1 million, or on the between the basis of the assets and the $1 million. If you happen to give an IRA in kind, that could be even worse because that's probably 100% ordinary income. So whenever I've got a large distribution and trust, maybe that's a case where you might want to amend the trust to grant withdrawal power instead. You know, might make a difference. So it's something to think about with non-grantor trust and distributions in kind, something to think about there. So let's walk through. I think we've gone through how this income taxation of these withdrawal powers work. But a lot of people, the next question is going to be, well, what about for estate tax? What about for asset protection? So let's delve into that and hit that for 10 minutes here. And for estate and gift tax, powers of withdrawal are considered exercisable general power, presently exercisable general powers of appointment. And they're governed by 2041 under the estate tax code and 2514 of the gift tax code. So if somebody releases a power of appointment, that could be a taxable gift under 2514. If you die with a power, you know, 5 and 5 powers, the most common that you have, 5% in your estate. Okay? So if we have a grant of power over taxable income and that power holder dies, that portion is in the person's taxable estate. Now, it's only going to be a small portion of the trust. Maybe you'd want to have the entire trust in their taxable estate, but that's using formula general powers of appointment, and that's another talk. But we want to understand how these powers of withdrawal work. There's also what happens if the power lapses. So if I've got a $1 million trust and I didn't take out the $50,000 of taxable income in that given year, I just let it stay in the trust, am I considered a contributor of that trust for estate and gift tax purposes? And that's where 2514 of the code comes in and says, well, for lapses, we're only going to consider lapses if they exceed $5,000 or 5% of the trust corpus, okay, out of which it could have been withdrawn. So if I let it in, if my income happened to be under 5%, no problem, I let it lapse. I'm not deemed to be a contributor to the trust. What if I did? So let's kind of walk through that in a couple of the estate tax powers. Let's see. Well, so in this particular example, in the Treasury regulation, You've got power to withdraw $10,000 a year. And this is an example right from the Treasury regulation. It's not a gift at the end of the year if the fund at the end of the year equals or exceeds $200,000, and you could do the math and figure out that's 5%, it's $10,000. If the fund is only worth $100,000, the failure to exercise the power is considered a gift back to the trust to the extent of $5,000. Okay? Now, for most of our clients, they could care less about this because, you're not worried about estate tax anymore. But it's something to keep in the back of your mind. You want to know how this works and be able to explain it to clients, even if it doesn't come up that often. Because how many people make more than 5% of realized gains every year? Not that many, frankly. I mean, unrealized gains aren't counted for this purpose, right? If your stock goes up, with the market, that doesn't count as income. So how does the estate tax work? If I die with this power of withdrawal, it's included in my estate. Same with the 5 and 5 power. How does that work for step up and basis? It's prorated, as you can see on that particular example. If the power were not exercisable until the last week of the year or the last day of the year, how does that work? Well, if the power is not presently exercisable, it's not included in your estate. So that's one way that you could draft the power so that 9 times out of 10 or 364 times out of 365, for instance, if I made it the last day of the year, it's not included in their estate. So if I say you can only exercise this power to withdraw all the taxable income on the last day of the year, and if you die before that, you don't have that power, well, then it's not in their estate unless they die on the last day of the year. So that's one way to get around that. Or if you could have a precondition on it. So estate tax, not as many people worried about it, but you do have to kind of understand how this 5 and 5 power works. If somebody's worried about the trust being included in their estate, just take anything excess above 5% out, right? Then you're within the 5% lapse protection. Now, what about state law asset protection? Because if you're not worried about estate tax, the family might still be worried about asset protection. I mean, that's the whole point of the trust, keep it away from creditors, right? So we care about the asset protection of the trust. Now, we kind of divide trust into states into 2 different categories. There's a surprising number that even if you had 10% or whatever lapse and go back into the trust, the entire trust is still protected under state law. But there's about 24 states, which includes my state of Ohio and also Idaho, that have the asset protection geared to the 5 and 5 protection. In other words, they incorporate 2514 of E of the code right into the state creditor protection statute regarding who's a settlor of the trust. So in those states, I'm going to just kind of assume that law applies. So let's use our example. John's got the power to withdraw all the net taxable income from the trust. It's a BDOT of a $4 million trust. There's a great year. They hit the socks off, or maybe they sold some capital gains or whatnot. The trust income this year was $400,000. That's 10%. Now, if John lives in Ohio or Idaho or one of these 24 states, and he lets it ride, he lets the $400,000 go right back and stay right in the trust for him, doesn't take out a dime, then he's considered a settlor as to $200,000 for asset protection purposes. Okay? It's considered like a self-settled trust. So that impairs the asset protection somewhat of that trust. So what are some solutions? Well, let's just walk through a few of them. If he just simply takes out half the income, which in most cases, is it hard to get beneficiaries to take out income? No. They're going to take it out. I mean, at the very least, even people that don't need it right away, even our wealthy clients, I've worked with a lot of wealthy clients, and some of them actually do leave money in trust, typically because it's GST exempt and they don't need it, they're wealthy enough. It does happen sometimes, but most people, especially if they know they're paying the income on it, they're going to take at least a portion out. In this case, if John takes out $200,000, then how much is the lapse? $200,000 out of $4 million, it's 5%. He's not considered to be a settlor as to that $200,000 that's retained in the trust anymore. Problem solved, just by taking some of the money out. Now, what if he didn't, if he still wants that money to be asset protected, he could fund a SLAT, an ILIT, he could put money in life insurance, he could set up a Nevada or South Dakota, Delaware trust with the money. There's some other solutions on this slide. You can use a DAPT statute, to start with. If I set this up in a state like, that had Nevada, for instance, made a Nevada trust, and we have offices in Nevada and South Dakota and Ohio, Delaware, and these places. You probably don't even have to worry about this, But let's assume you're going to stick with a, standard Idaho trust. There's some other solutions. You could cap the power if you wanted to. I'm not sure I would do that. You could just use the power, and simply take out the money and then just put it into some other asset protection vehicle, 529 plans, life insurance, tenancy by the entireties, it doesn't matter. You could have a hanging power, conceivably. So let's say I didn't like those solutions. If you had a hanging power, that power would hang into the next year, just like the hanging power most of you are familiar with crummy trust and ILITs and things like that. Same concept. If in this particular instance, if you had 10,000 above the withdrawable amount that hangs until the next year, well, let's say in the next year the taxable income was only 4% of the corpus instead of 5. Well, then that power that was hanging into the next year lapses in the next year, because you're probably not going to make more than 5% realized income every year, So that's another option. It's a little more complicated, but so it's an option, but I don't know that you'd use it all that often. Under bankruptcy law, just to kind of, round the circuit so we understand how it works under different state law. For bankruptcy law, a presently exercisable power is subject to the bankruptcy estate under Section 541 of the code. But again, if I have it exercisable with, if it's presently exercisable, it's subject to creditors, but if it's lapsed, it probably wouldn't be. It's going to go under whatever the state law says. So what's another solution for asset protection purposes? You can add a provision in the trust, either, and this is called, the asset protection gurus, they call this assessor clause or forfeiture clause. And some of you have probably seen this. It's basically a more robust spendthrift trust provision. And so if you've ever seen a clause that says in the spendthrift trust provision that says, no beneficiary may assign or alienate this interest, that's a spendthrift clause, right? But if you see a subsequent sentence or two that says, not only that, but any mandatory withdrawal rights or mandatory interest are hereby cut off if that happens. That's a assessor or a forfeiture clause. You could have that clause in the trust, and as long as it's prospective, if somebody gets into creditor problems, it cuts off the withdrawal right. This has been honored under the bankruptcy code for many, many years, so it's not like considered a fraud on the court or anything like that. So here's a way to have my cake and eat it too, where maybe I don't like this withdrawal right idea if somebody's going into bankruptcy, because their bankruptcy trustee is going to be able to withdraw the income, right? But if I have assessor clause or forfeiture clause, or I can also give this power to a trustee or a trust protector too, right? That basically cuts off the withdrawal right, then you've protected the assets. So that's another way to kind of basically increase the asset protection of the trust. So there's a lot of law behind that actually that protects those types of clauses and interest in a trust. So when it's cut off for bankruptcy trust purposes and as well. So let's just walk through why that may actually be better than a wholly discretionary trust. Because if you've read articles on discretionary trust, or you've seen Dick or Steve Oceans or anybody that talks about asset protection planning, or Gideon Rothschild, you read all these articles, everybody says that the most powerful thing to ever have is a fully discretionary, third-party created trust. And I probably said that in articles that I've written in the past too. That's, as far as it goes, that's probably a good general rule. But what if we had a withdrawal power that is subject to this forfeiture or assessor clause, right, that would be cut off in the event of creditor attack? Actually, the asset protection for this could be much better, because what you're doing is you're by having this BDOT provision in the trust, you're having the beneficiary pay the taxes on the trust. So by paying the taxes on the trust, they can use outside assets if they want, right? Just like any kind of idjit, right? So by paying taxes, the BDOT's trust tax out of their own non-asset protected assets, over time, you're depleting the assets that are not asset protected, and you're increasing the assets in the BDOT that are asset protected. Whereas if we use a typical non-grantor trust, what do people do to shift the taxation out? You make distributions, right? So what we've got here is, I just used an example with some really simple numbers here of Joan. She's a primary beneficiary of a discretionary trust funded with a couple $1 million from her late mother. Every year it grows at 4% unrealized, 4% realized income. Now, if you have a normal trust, you're going to distribute out all the 4% to get the lower tax rates, typically. But on the counterfactual, what if we used a BDOT provision, and maybe she didn't take out all that 4%? Maybe she just took out a certain amount to pay tax, or maybe she paid the tax out of her own assets. What happens is the BDOT is going to grow much higher, because it's less is being taken out of a trust with that design of withdrawal power. So when she's sued and files bankruptcy, maybe for whatever reason, her withdrawal rights would be eliminated under assessor or forfeiture clause or by a trust protector, whatever your preference would be in that. Which situation is more protective in the long run? If this had gone on for 10 years and the BDOT is going to have a much higher, corpus, that much more is protected. So our first instinct is any trust with a withdrawal right is inferior for asset protection purposes. But the important thing is the asset protection doesn't really matter every year. It only matters when the creditors come knocking at the door, right? That's when it matters. And so if 10 years goes by and the withdrawal powers are cut off and I've got a BDOT with twice as much money in it as an ordinary trust might, you can see where that is much more protective in the long run. Also, it could be better for somebody that has a taxable estate. Now, in my example, with $2 million, maybe that's, but maybe in 2026, maybe with a new presidential election, maybe the estate tax matters more. We'll see. But the key thing is having this kind of provision and monitoring it and not taking the full amount out allows this asset protected trust that's also sheltered for estate tax as well as asset protection purposes is enabled to grow more than an ordinary discretionary trust would in many cases. Because in discretionary trust, they don't just withhold all the money because of the tax reasons typically. Now maybe that's different if you've got a super wealthy family where everybody's making over $600,000, but in most cases, the trusts are paying out a lot of the income out of a discretionary trust. So if you have a, this one's a partial release. Some people have asked me, how is this trust treated if the forfeiture power goes away? And typically it would probably go to non-grantor trust status at that point. Now, if you have you could say that if there's a partial release and maybe it's a part grantor trust under the 678A2, I don't want to get into that too much because it's kind of getting into the weeds a little bit from the main point. How many people are here familiar with the term BDIT? Anybody here listened to Dick Oceans before, read any of his articles? Or I think Jonathan Blottmacher wrote an article about it too, and Howard Zariski and a few others. Anybody here familiar with it? Okay, maybe one or two. In essence, not as many of you are. It's basically a trust that's trying to deem the income taxable owner to the beneficiary, but by granting the beneficiary a power to withdraw the entire corpus. And so these are typically only funded with how much? $5,000, right? So you have your mom or dad give $5,000 into a trust for you, and you have a crummy power, basically, 5,000 power withdrawal right. Now I've got a trust for me that's wholly taxable to me under 678, okay? Just like the BDOT is, right? But the problem is those are only funded with $5,000, and typically they're doing multi-million dollar transactions with them, and the IRS put that on the transaction of interest list. not for not because it's under 678, but because what they're doing in these typically is they're funding it with a really small seed gift of $5,000, and they're doing multi-million-dollar installment sale transactions with them, and the IRS put it on their transaction of interest list because why? It just smells funny to them, right? Transaction of interest means we don't like it, but we can't really articulate why, right? So here, if we go back to my example with Joan, who inherits $10 million into a BDOT, how much seed gift is there? $10 million. We're not talking about like some small pittance to justify a huge transaction. You've got a much larger amount that could go into a BDOT trust. However, the problem is if the income right is cut off, if you had creditor issues and the income right is cut off, it would cut off the grantor trust status. So you would want to undo any installment sales before anything hits the fan, so to speak. But you can see where it could be really valuable there. So that's the difference between the BDOT and the BDOT. Your BDOT trust are basically trying to establish a power over only the corpus of the trust, and they're very limited because of the lapse provisions of 2514. So with crummy powers, you could be excused for thinking this is very similar to a crummy power, but under 678, if I grant somebody a power to withdraw the taxable income, that may not necessarily qualify for the annual exclusion gift, because it's only a power over the income over the year. It's not a present interest necessarily, especially if I have a forfeiture clause in it that could cut it off later. So if you're setting up a gift to a trust, don't count on with this type, I'm going to set this up as an inter vivos trust. You might want to grant the beneficiary with a crummy power concurrently with if you'd want to, get the annual exclusion gift amount for that. So what about the tax effect of amending these? I went into this earlier, and maybe if you have an existing irrevocable trust, if you get the parties agree, the court to agree, you might be able to amend really large existing irrevocable trust to come under these kind of same terms. And there's some additional discussion of amending irrevocable trust in the white paper cited there. Sometimes you can decant. I don't think you still don't have a decanting statute here in Idaho, right? Yeah. So maybe not here, but I guess you could move situs to another state and decant, perhaps. But it may be just as easy to get an amendment done, frankly, as decanting. A lot of trustees are a little bit leery of doing really substantial changes by decanting anyway. For good reason, perhaps. Whereas if you get the court to sign off on it, everything's going to be pretty kosher for that. So I'd like to just kind of summarize some of the main points here. And I know it's been a long, right after lunch, it's kind of a heavy topic at some point. But I'd love to take questions about any of this kind of stuff as we go, too. I'm sure we'll get a couple. But here's just a summary. Trusts are going to be separate taxable entities unless the grantor trust rules apply. But after the settler's death, they're always going to be non-grantor trust unless we can trigger 678 in some way, this power to withdraw income. And again, we could have the power to withdraw. If we just say income generally, that's only going to be accounting income. But if we define the withdrawal power to refer to all taxable income, okay, and I might even want to include muni bond income in that. Why? Because it might be taxable for Idaho, but not for federal. And I'd just as soon have it be over everything 100% certain. So I'm going to define it very broadly. Then it's going to be taxable to them. I want to have that power over even phantom income. If I got a K1 for 100,000, but the distribution from the entity is only 60, I want the power to withdraw to be over 100,000 to include the phantom income. So that's something to consider when you're drafting too. If you're in a state like Idaho and there's a 5 and 5 state law protection for lapses, you want to pay attention to that. Here's a thought for you though, in bold. In many cases, you may have situations where maybe when some beneficiaries in their 20s and 30s, you want to be more restrictive, but at a certain point, you're going to liberalize the trust, right? Maybe at some point, you have the trust convert to this type of trust, right? That would be a great kind of clause to give that power to the trustee or to a trust protector. if not automatic. You could have it switch to a BDOT at age 30 or 40 or something like that, right? When you feel like the beneficiaries are going to be at least a little bit responsible, and that's a good balance between making ultra-liberal distribution standards, grant the power to withdraw the taxable income. Also, by the way, could you have a power to withdraw taxable income, but also a concurrent power to distribute more? Absolutely. So you may have a situation where maybe the taxable income in a given year isn't all that high. You got a down market, right? Could you say 5% or the taxable income, the greater of? Could you also say power to withdraw the taxable income, but you know what? The trustee has the power to, in the trustee's discretion, to also distribute principal. And you could also say something along the lines of, this should be relatively rare since the beneficiary has the right to withdraw all taxable income, but for XYZ reasons, health, emergencies, et cetera, the trustee can distribute more. There's nothing wrong with that. It's still going to be taxed to the beneficiary. And when the beneficiary gets an additional distribution of principal, it's a non-event, okay? Because there is no D&I in the trust to be distributed out, okay? So that also enables you to do some different tax shifting, So having these powers in a trustee or trust protector to be able to maybe amend and change the trust later, you could see where that could be really powerful, right? And as I mentioned earlier, to cut it off too, And just like you may have a provision in there to have trustee discretion. So over the long run, I think that if you have a forfeiture clause or some kind of clause in the trust protector or some other clause that can cut this off, in the long run, it's going to be actually better asset protection potentially for the beneficiaries. And by beneficiaries, I mean not just the current beneficiary, but for the remainderment as well. So that's the nutshell summary. I know I've hit a lot of different points. It's a very simple concept, of course. The 678 is only a couple sentences, and you can see where drafting the basic withdrawal power is super easy, right? What becomes a little bit more complicated is, well, do I want to put it at the end of the year? Maybe you don't want to have the withdrawal power on December 31st. Why? Because if I want to do transactions between a beneficiary and their trust, is it a beneficiary deemed donor trust as to that given date? I might want to have the income withdrawable over the entire year. So you can see where if I put this forfeiture clause, that adds a little bit of a wrinkle, a little bit more complexity to it. But otherwise, the concept is pretty simple, and it's simple to explain to clients too. Have anybody ever tried to explain the Principal and Income Act to clients? Oh, well, I know you think that this $100,000 distribution to Miss Widow is all taxable income and that your trust pays out the income and that she should get $100,000. But we have this special rule under the Principal and Income Act that it's only $10,000 of income. But wait, the 1099 says $100,000. Well, but we got this really cool Principal and Income Act that limits your distribution to only $10,000. That goes over really well. But explaining what taxable income is really easy to the beneficiaries. It's really easy to set laws. It becomes a little bit funky. It's a little bit different dynamic. For a corporate trustee that's managing investments and things, it's a little bit different dynamic, right? Somebody's got the power to withdraw all the taxable income. You have to manage things a little bit differently there, right? Because you have to have, you could withdraw the assets in kind, but you don't necessarily want to do that all the time. So it's a different way of looking at things, and I think we'll see probably, more talk and discussion about this at different conferences. I know a lot of attorneys have called me up and they've got their own spin on different things. So I think we'll see increasing use of this, and we'll probably see eventually some, this kind of clauses pop up in certain rulings like that 2016 private letter ruling. Now that was an odd thing, but I don't think we're going to set many trusts that set up other trusts to do this. The most common application is going to be just your garden variety middle class planning, right? You want to simplify things. You want to avoid all these gotchas in the code like the 121 and 179 and all these kind of things. Make it simple, report it on the beneficiary's 1040, boom, it's simpler, everybody likes it, it's easy to explain. So that's, in a nutshell. The only other slide I have here is if you come back to this and you think about it and you want to implement in your practice 6 months later from now, a year from now, go to this particular website and I'll update the white paper But I think y'all would have gotten the PDF and the slides from Tom, I think, already earlier. But, you've got my email on this slide too. If you want to email me and chat, if you get some questions that you think about after this, I'd be happy to take these. I may not answer the same day, but I love talking about this stuff, so happy to take the questions.
Flexibility can you give the trust protector or the trustee the right to define what income is for a particular year?
Repeat question.
Yeah. Let's repeat that. How much flexibility can you have in every given year, and do you give that to the trustee or the trust protector? I think you could give it to either one. And I think under the code and regs, it would be hard, even if I changed it up every year, I think it would be hard for the IRS to contest that. Now there was a particular ruling that they came out with a few years ago where they expressed some reticence about toggling clauses. But the particular ruling where the IRS was worried about toggling between grantor trust and non-grantor trust status, people were manipulating options and selling interest in trust and doing some really abusive things with it. Whereas I think if you just have a garden variety trustee, I give you the discretion to grant a power of withdrawal or not and change it every year. There's nothing really abusive about that going on at all. So I think you could certainly give that power to the trustee or trust protector, either one, and I think it could change quite a bit every year without any ill effect. If you think about it, worst case scenario, the IRS says, well, we think the trustee is manipulating this for income tax purposes, what would their remedy be? Would they call it a wholly grantor trust, or would they call it only a non-grantor trust? They would have no way to decide which one to be. What would their remedy be if they did think it was abusive? I don't think they would have one. It's not like other cases where they have a very clear remedy of here's how we think the law should be, and so we're going to cut it out. So that's my take on it. Did I answer your question?
Yeah, the question is, if you want to leave a portion of the income in taxable, whatever it is, like trust, and allow the trustee to make that call, here's your right of distribution based on county income versus taxable. The trustee or trust protector has the right to decide every year, I'm going to grant you a right that's limited to county income, or whatever you want to call it, but typical trust versus taxable. If for some reason you want to play with rates or do something between the trust and that beneficiary, allow the trust, I'm sort of notice provision, allow the trust protector to say, this year your rights equal to X. Taxable income is another number, and that right shifts every year.
Yeah, and to get the comment on the recording, the gentleman was saying, well, wouldn't there be some advantage to having that withdrawal power change either through the trustee's decision or the trust protector's decision every year? And I think you could. For instance, let's say there was a provision in there to grant distributions to charity, either through a limited lifetime power of appointment or through a trustee spray power. I'd prefer a power of appointment because then they're not vested as a beneficiary entitled to reportings and accountings. So let's say that'd be a good reason to. Or if you wanted to eat up the brackets. So you might say, you can withdraw everything above $12,500 plus whatever charitable contributions are made. Okay, so if you make $10,000 of charitable contributions, then everything above, $22,500. Now, you're kind of slicing a little bit thin. What you're doing there is you're making it more complicated because it's a part grantor, part non-grantor trust, and you're filing a 1041 every year, which maybe you've got $500 of extra accounting expenses because of that potentially or something like that. But you could see where the advantage would probably exceed whatever accounting expenses. And maybe you're a CPA and that's a good thing for you. But yeah, $1,500, whatever the additional amount it might be. That might be a little bit on the low side for some of you, but you get the point. I'm kind of differentiating between a grantor trust and a non-grantor trust filing. So you're going to have some accounting additional cost even for a grantor trust, maybe because you're going to have the trustee has to give the beneficiary a report similar to 1099 of what income to report on your tax return. If they're not the trustee, there's no reason that these can't be used with individual trustees, but you can see where
having a corporate trustee, whenever there's anything outside the box and a little bit different, that's new, it does have certain advantages. It's certainly more advantageous. That's a factor, and if you ever look at the trust piercing cases, so when does a creditor ever pierce a third-party trust? They're pretty rare. I wrote an article last year where I compiled all the cases and gave some, if anybody's interested in that. They're relatively rare, but the ones that do, even the ones that protect, do cite whether they have an independent trustee or not as one factor. I mean, that doesn't mean just because I name my sister as trustee that, for my kids, that they can pierce the trust. But it is one important factor to have an independent corporate trustee, because all the books and records and tax returns are going to be done properly as a general rule too. And so there's some advantages whenever you're doing something a little bit outside the box. Plus, I think to an IRS auditor too. Now the audit rate for 1041s is abysmally low. They hardly audit any, and the ones that they do involve a 642C deduction probably. At least that's what I've heard from people that do these all the time. And so you might expect an audit. If I structured a non-grantor trust just to get the above the line 642C deduction, like I mentioned, it's a cool idea. I think there's a lot of authority behind the result, but I would suspect that might be a red flag to an auditor, just a fair warning, I could defend it, but, if there's one thing that might be a red flag, that might be one. It's like, wait a minute, this trust is set up and all the income coincidentally is going to the charity, and it varies every year. It might not though. What they look for when they audit is, what's a little bit unique about the trust charitable deduction that is not a problem with individuals, is you have to source it to gross income. So no, you and I, if we go out and we give some asset that was gifted to us and we gift it to charity, it doesn't matter. I mean, we don't have to, source whatever we give to charity to our gross income, but trusts do, and there's some quirky rules about trust. You don't get the same rules when you gift from business income. You might get a haircut, for instance, or it might be denied altogether when I gift business income, like from a LLC or S corporation passing through under 681 of the code. But anyway, I'm kind of devolving a little bit outside of the box here, but the nutshell is, if you kept a simple grantor trust, either all or nothing every year, I don't see that as an audit risk at all, too much. If you tried to parse it out, that might be. Also, if you have a part grantor trust, remember you'd have to divide up all the expenses prorated. So if I have let's say I had a part grantor trust as a $10,000 out of $100,000. Well, now I've got to go through and I get a 6070 deduction for trustee fees, but only as to 10%, And so I've got to divide up all the expenses and everything. So it might be, I don't know, maybe that's great for the accountants in the room. It makes a little bit more work for you. So, there's that in mind. That's why I think probably 9 times out of 10, if you're going to set these up, it's going to be all or nothing, because the simplicity is one of the benefits of this, right? But if you wanted to be fancy, you could parse it out a little bit further. So, any other questions? Yeah.
Ed, you mentioned you can get Q-tip treatment by giving the surviving spouse a right of withdrawal rather than a mandatory distribution right.
Right.
Is there any downside to doing that, or are you suggesting why not do this with every Q-tip?
I think that's a good point. I would probably say, why not do this with every Q-tip? Now, in most cases, so if you're in this scenario where you've got a second marriage, third marriage, fourth marriage situation, where somebody does want to minimize how much the surviving spouse can get, there's not much difference between the right to withdraw the accounting income and the trustee's mandatory distribution of accounting income, because in both cases, the accounting income is going to go out on either on a K-1 or on the beneficiary's return directly. There may be some, so I would probably stick with the standard drafting for that type of scenario, where I'm not going to be over the entire taxable income, for the reason that you might be able to get slightly better deductions as a non-grantor trust that pass through. Particularly with the itemized deductions pretty much canceled for individuals now. So like when I have a trustee fee, if I pay a wrap fee for investments, for instance, from my personal, I don't get a deduction on my 1040 Schedule A anymore, right? Whereas the trust still gets at least some above the line deduction for the trustee fee. So there might be some really small benefit at the margins for keeping the standard mandatory distribution. But I think in most cases, when you've got a Q-tip where you want to grant the power to withdraw all the taxable income, that's where you get more power. You got more opportunities open up, and it's a little bit simpler. And you've got the other opportunities that I talked about here. That's where I would probably be more inclined to make it a withdrawal, a BDOT type provision in the Q-tip. Did I answer the question? Okay, any other questions? Yes.
Question. So my understanding is when you have a non-grantor trust, a lot of times we use the social security number or of the owner, or we apply for an EIN and file the grantor trust return. But if that flips to a non-grantor trust, at some point you have to apply for a new EIN for the non-grantor trust. So when you're talking about switching back and forth, how do you deal with the EIN reporting for that trust?
Okay, and to repeat the question, how does it work if you do flip from a grantor to a non-grantor trust and back and forth for EIN purposes? So you're correct in that when you have a grantor trust or a beneficiary deemed owner trust, either one, you have the option of either filing under the social security number of the deemed owner, or you can get an EIN number separately. You have that option as well. It's optional. Whereas when you have a non-grantor trust, it's not optional. You have to have a separate EIN number. So if I switched back and forth, you might be getting lots of extra EIN numbers potentially, because if you switched from a grantor trust to a non-grantor trust and then back and back again, I don't think you could use the old grantor trust number that you had 3 years ago. I think you'd be getting new EIN numbers. And the very last section of the white paper has all the rules and regulations listed with examples on that, by the way. One example that I put in that particular section is one advantage to actually filing the 1041 as a grantor trust, and then, which is you just attach, instead of filling out everything in the DNI and all the distribution deductions, if you wanted to file a grantor trust return, you just file a really mostly blank 1041, and you attach the relevant 1099 type information to it for the beneficiary. One advantage to filing that is you might be starting the statute of limitations. So if they did say, well, that's not really a grantor trust for whatever reason, you've started the statute of limitations by filing a 1041. So that might be one benefit to actually filing a 1041 instead of just reporting it on a 1040, assuming you had a wholly, beneficiary deemed owner trust. But I think if you switch back and forth, you just end up getting different EIN numbers every year, I suppose. Which, again, more bills for the accountant maybe, but EIN numbers are free though, other than the accounting fees.
The assets.
What's that?
I said the effort to move all the assets into the new EIN. Takes some time.
Yeah, the effort to move. So you've got different. The question, follow-up question was, what about the effort to move the assets? And so a lot of banks and brokerage firms would require closing down an account and moving an account. If you've got real estate, though, that's not changing. It's just the trustee. They don't care about an EIN number. So it kind of depends on the asset, of what kind of burden there would be. But yeah, it could involve some. I don't know if they would require account closing because the EIN number changes. Probably so, is my guess. It's not my bailiwick at the bank, but I suspect they'd make you open and close an account. So one more thing to think about. So I can't believe we actually ate up 2 full hours here, and you guys have not bailed on me yet. But thanks for having me. It's good to be back in Boise, and thanks Tom and Dave for arranging this. It was good to be back here again, and I'll be around for a few minutes for any more questions. Thanks.